Hi everyone, I'm Jeremy Zirin, Senior Research Analyst for Real Assets, and the title of my flash talk is Exploring Opportunities in Non-Core Real Estate. But non-core real estate can mean a lot of different things. For some, it might mean value added, and for others, it might mean opportunistic or even development. Well, I'm actually not going to be talking about value added or opportunistic, and instead, I'm going to be focusing on non-traditional property sectors such as senior housing, student housing, life sciences, self-storage, and why these sectors are important, particularly in today's market environment. Before I begin, my agenda will include a discussion on the key attributes of non-traditional property sectors, followed by a handful of case studies, key performance benefits, how to invest, and finally the key takeaways. But before diving in, I want to first frame the conversation with a quick comparison between traditional property sectors and non-traditional property sectors. Traditional property sectors such as retail, office, industrial, and multifamily should be what you're most familiar with because these sectors represent the majority of the institutional real estate investment universe and are most likely in your real estate portfolios. While each of these property sectors are unique relative to one another, the well-being of most of them is tied to the economy. For example, the office sector tends to underperform in recessionary periods as a result of companies deciding to downsize. Non-traditional property sectors, such as senior housing, life sciences, student housing, and self-storage, on the other hand, require specialized knowledge and resources and have a wide range of demand drivers that can be both cyclical and secular. Some of their unique features include fragmented ownership, where the bulk of properties are still owned directly by specialized operators, mom and pops, or even health systems. They also exhibit defensive characteristics such as stable operating fundamentals that are less correlated with the economy, and a needs-based demand which creates sticky tenants with higher retention rates. And lastly, demographics, which can provide a picture for future demand, which I'll have more on later. So let's dive right in with some attributes. The senior housing, medical office, student housing, and self-storage sectors are believed to have $1.3 trillion in real estate value. To put this in context, $1.3 trillion only represents about 12% of the total real estate investment universe, but the market size for non-traditional property sectors is growing. Investors in these non-traditional property sectors include institutions, both U.S. and foreign, as well as private capital and public capital in the form of specialty REITs. Non-traditional property sectors have many unique characteristics, but one of the key attributes is that they are less sensitive to GDP compared to traditional sectors. This chart shows the sensitivity of value to a 1% change in GDP. You'll note that manufactured housing, student housing, medical office, self-storage, active adult, single-family rentals, and senior housing, all non-traditional property sectors, are among the lowest. If you believe we're nearing a market correction, then this is a key feature that may help provide protection in a down market. Okay, let's have a little fun. Would you believe me if I told you this was my living room? Well, now that I just got married in July, there's no way my wife would let that happen. I may not be a hoarder, but together we had a lot of stuff and not enough room, so we decided to get self-storage. Self-storage. Can you believe there's a whole industry based on keeping an eye on your stuff? Self-storage doesn't just provide storage space for the hoarder community. In fact, usage is driven by life events such as moving away, going away to college, divorce, and even military deployment. Self-storage is also good for businesses when they need space for inventory or records, and when the seasons change and you need a place to store your boat. Many of these events are non-cyclical and can take place at any time of the year, regardless of the state of the economy. Self-storage has historically exhibited low correlation to GDP, high net operating margins, and low capital improvement costs compared to other traditional real estate sectors. For instance, capital expenditures as a percentage of net operating income for self-storage is approximately 5%, which compares favorably to retail and office, which can be as high as 19% and even 28%, respectively. Okay, would you believe me if I told you I lived here? Well, I did. In fact, this was my dorm that I lived in freshman year of college. It's Douglas Hall at Northern Illinois University. While I wasn't living there when it was under construction, when I was there, it was still a dump. It was very outdated, had small rooms, and there was nothing attractive about it. Now this is what new student housing looks like today. Modern amenities with purpose-built communities and entertainment in order to attract students. Student housing is a unique property sector because demand is driven primarily by demographic and enrollment trends, which result in a defensive and resilient investment strategy, particularly during times of recession. This chart illustrates this point by highlighting the inverse relationship between job growth and college enrollment during times of recession. Also unique to student housing, leases renew every 12 months and are often backed by parent guarantees for rent payments and, of course, damages. Can you tell me if you know what sport this is? Well, if you've guessed pickleball, then you're right. Pickleball is the new shuffleboard and a popular sport among the active adult community. Active adult communities, for those of you who are not familiar with the term, refers to age-restricted communities, typically 55 years old and older, with amenities, activities, a la carte services, and social groups that are typically located near destination-type retail and entertainment. In fact, I have an aunt who lives in a senior community down in Delray Beach, Florida that was once a thriving active adult community, but it doesn't look anything like this picture today and instead reminds me of a Seinfeld episode with Jerry's parents who live in Del Boca Vista. Can you picture it? Well, even though her community hasn't changed since the day she moved in over 30 plus years ago, it's actually in a great location because she doesn't drive and is only a few blocks away from a casino, and she walks to that casino every day for entertainment. The aging baby boomer generation is expected to generate significant demand for seniors housing over the next several decades. 40 million Americans are currently 65 plus years old, and this group is expected to increase to 72 million by the year 2031. 12.7 million Americans, shown in this chart, are currently 80 years old, and this group is expected to increase by 3.9% annually through 2031. There's a wide spectrum of senior housing communities ranging from age-restricted active adult, which doesn't require any care, to skilled nursing, which requires 24-hour care. To run a successful seniors housing program, it's critical to partner with experienced operators. This is not the case for traditional property sectors, which don't require the same level of servicing. From an investment standpoint, there is a huge need to replace outdated facilities, just like the one my aunt lives in, and within the independent living, assisted living, and nursing home communities in which demographics are driving demand. Do you know what city this is? Well, if you've guessed Cambridge, you are right, because this is Cambridge, Massachusetts. And if you're wondering what's so special about it, Cambridge is one of the top life science clusters in the world, and it's situated right next to MIT, which is highlighted in the red zone on the right-hand side. Life science companies include large global pharmaceutical companies, known as Big Pharma, medical device companies, research universities, healthcare institutions, and even startups. While many of these life science firms are located throughout the US, most have now clustered together in cities such as Cambridge, San Francisco, San Diego, New York and New Jersey, North Carolina, and even Seattle. The life science sector is the most research-intensive industry in the United States, with approximately $100 billion in annual funding. Powerful demographic drivers are boosting demand for the life sciences and healthcare sectors generally, given the aging population and drive to cure diseases. Decades of research and development have led to new drugs and medical treatments ready for commercialization. Compared to traditional office buildings, life sciences and lab offices are difficult to operate and require close property management and tenant relationships. The buildings themselves contain a combination of uses such as lab space, research space, and specialized computing space, which are all very expensive to build out. The tenant improvement costs can exceed $250 per square foot. Compare that to $20 a square foot for a traditional office. From an investment standpoint, however, the life science sector is a high-growth sector within real estate, with above-market NOI growth that outpaces traditional office buildings, as shown on the table on the right. I've highlighted some of the benefits and demand drivers of non-traditional property sectors, so let's look at historical performance. Peak to trough, education, healthcare, and storage sectors achieved higher total returns than traditional sectors during the last recession, starting from year-end 2006 to mid-2009. Student housing was impacted less by the global financial crisis compared to traditional apartments. Net operating income continued to grow during 2009 through 2010, and demand increased since more students returned to school during the recession. And you'll know that while self-storage experienced limited NOI growth during this period, NOI rebounded faster than traditional property sectors as a result of short-term leases that helped take advantage of rising markets compared to traditional sectors with longer-term leases. Okay, so how do you invest? There are many ways to invest in non-traditional property sectors. Private funds are available, either sector-specific or diversified funds with both closed-ended and open-ended vehicles and with different risk profiles, but the options are much more limited compared to the public market due to how operationally intensive these sectors are. It is critical to have relationships with the right operating partners, which most traditional real estate managers don't have. As of the end of 2018, there were 85 non-traditional publicly traded REITs across 12 different sectors with a market cap of over $550 billion in the FTSE Nareit All Equity REIT Index. On the public side, it's common to see REITs that are either specialized in one particular sector or diversified in several. For example, healthcare REITs may invest in senior housing, medical office, and in some cases, life sciences. So to conclude, non-traditional property sectors require specialized knowledge and resources and have a wide range of demand drivers that can be both cyclical and secular. As a result, these sectors exhibit defensive characteristics which can help protect in a down market and may act as a complement within your traditional core real estate portfolios. Thank you.